Good morning, guys. To purpose this trade, and on this video, I want to talk about five major mistakes people make when they first get into trading. Number one, panic trading. And you have no idea how many times I've seen newbie traders. They'll get into a position, buy a long put, whatever, buy a stock, whatever it is. But the moment there's a bad news, the moment the price goes against their expectation by a slight amount, they sell it and they get rid of the position. And look, I understand why some traders who are high frequency traders they want to get out while holding on to a stock, but it's really about your analysis level. Because look, there are many traders out there who will tell you exactly opposite of what I'm telling you, which is that focus on high frequency trading. If you, for example, buy a stock or hoping its prices to go up, but if the prices go down, sell it. Don't wait for the prices to come up again. Because, and those same traders will also tell you that if you buy a stock and the prices go up, you should buy more of the stock. And that kind of high frequency trading is not ideal for a newbie trader. And also, high frequency trading works, and I talked about this in a previous video, it works in uh, interest rate environment because in low interest rate environment, there's high liquidity in other financial markets. And in high interest rate environment, which is what we're going to live in the next few decades, the liquidity will not come up to the level it was in the last few decades. So transaction cost will be higher. I talked about this in a previous video. You can go and watch. Higher spread, higher transaction costs. So high frequency trading will require you to have a high edge. Long story short, if you have analyzed the financial instrument, stock, whatever it is, the company, and you have your gut telling you that it will go up in the long run, stick with your gut. Don't sell it just because the price dipped a bit. Don't keep buying more just because the price increased a bit. If you looked at the balance sheet of the company, look at its mission statement, its market share, its future prospects, its CEO, its history, its executive team's history, the balance sheet, the last few earnings report, the amount of shares floated in the market. So that means basically the amount of shares bought by public. So for example, if 20% float means 20% of the shares are owned by people trading on the stock exchanges, and the rest are owned by institutional investors and insiders. Look at all those factors. And then if your gut says this company will go up in the long run, decide how much you want to invest and buy it. Have a target price. I'll buy it whenever the price goes to this level, I'll buy it and buy it. Don't get into that mindset. Oh, if the price drops a bit, I'm not gonna wait around to see if it goes up. I'll sell it and then go. Every time you sell something at a loss, you have to make twice that to make up for the money. We talked about this. Selling at a loss and losing your capital means next time you have to make up for the capital. And if you have $100 and you lose $50, so you're left with $50. So next time you have to make 100% return. So for a 50% loss, you have to make a 100% return. So that's why I don't like that high frequency strategy of just sell at a loss, you'll make up in the next trade because you have to make a significantly more money in the next trade because now you have diminished capital. And I believe in value investing and investing with your guts. When you look at all the stats regarding a company, go with your gut, decide on a price range where you will buy, and that's it, and hold on to it. Hodl, that's as they say, right? Industry term. And yeah, this is a big mistake that people make. So that's mistake number one, panic trading. Mistake number two is trading around earnings date. Look, stocks are going to be volatile around earnings date. When they give their quarterly earnings report, annual earnings report, stocks are going to be volatile. Doing your trade around those time is extremely uh, unadvised. Not, I don't like it because that's not a true reflection of the stock's value. A lot of people have position on a stock. They're waiting for the quarterly report to come out to decide if they want to continue holding the stock. So they'll close up their positions that, stuff like that happens around earnings report. So whatever valuation of the stock happens around earnings report, I strongly advise and recommend people to not trade at those times because a lot of people are looking to close their positions based on the latest earnings report and all that. So you're not going to get true valuation by trading around earnings report. And then tip number three is similar to tip number one, which is trading in low liquid environment. Do not trade in time at times when there's low volume in the market because you'll face what's called artificial price, and that is very simply what is a stock price? What is the financial instrument price? It is the price that instrument was traded on the last few trades, whatever period of time. If you have low volume trades, it's easy for someone to come in, do a few trades, make a few loss, but change the price significantly. So don't trade around low liquidity, low volume March time. That's tip number three. And tip number four is look at the company's balance sheet. And this is an obvious advice, but you have no idea how many people avoid this. And they'll tell me, oh, I bought this stock because it's on the news, because my friends told me, blah, blah, blah. Look at the cash flow. Do they have a net cash flow? If they have a negative cash flow, they're likely to be issuing shares to raise capital to pay off existing and future debt. Look at the cash flow. Cash flow is king. You have to understand this. Cash is king. If a company is not generating cash, negative cash, positive cash, um, so yeah, look at the cash flow, see if the cash flow is positive. If the cash flow is positive, it's good. But if it's a negative cash flow, they have to raise debt to keep the operation running. So yeah, cash is king. Look at the cash flow. A lot of people overlook this factor. They focus on book value, price to earnings ratio. Cash is king. In the high interest rate environment we're going into the last next few decades, cash is king. So that's tip number four. And tip number five is this, I guess, goes uh, it's regarding leverage trading. And now look, trading with multiplier, trading with leverage, trading with the short position, all of this requires you to have margin on your account. And if you don't know what that means, don't learn. Okay, that's one term you don't need to learn. Trust me, you take it from me. Learning about leverage, learning about margin and equity, nothing good will come out of it. You're just going to lose a significant amount of money, whether you're an individual or institutional trader. You're okay. Here's the problem with leverage trading. And I'll just give you a simple example. So let's say you buy $10 of a stock. If the stock price increases 1%, you made 1 cent. If you have 500 times leverage on that $10 and the stock price increases 1%, you make 500 times profit or $50. But at the same way, for whatever reason, for a short period of time, if the stock price decreases by 1%, and it happens all the time, 1% decrease in the short run is nothing. But because you have a 500x leverage, your stock instrument valuation has decreased by 500%. And if you don't have that 500% loss in your account, or in this case, if you don't have $500 in your account, your position is going to be closed. So even though the stock might go up in the mid to long term, but because of the 1% dip in the very short term, your position has been closed and you lost $10 and whatever margin you had remaining to keep the position open. I highly recommend people don't do leverage trading. Don't get into trading on margins. It's a gamble on a level you can't imagine. Stick to the basics, stick to the positive uh, fundamentals, and you'll be fine. You're not gonna get rich overnight. So yeah, that's my advice, and that's it for this one. We'll come back with another video pretty soon. I'm thinking about making a video on risk arbitrage, and if you guys don't know what that is, you're in good luck. I'll explain it to you in pretty simple terms. Until then, peace.